With Rebecca Patterson, Global Head of Foreign Exchange and Commodities at JPMorgan Private Bank, joining us from New York. Rebecca, good to have you with us. We're going to get into that Tim Geithner Treasury report in just a few minutes. But what about the weak dollar and the surging, emerging Asia currencies?
Well, this is really a dollar story, and the Fed is the elephant in the room. Everybody's watching for the November 3rd meeting to see what are they going to do, how much are they going to do, and the consensus is building that we are going to get more quantitative easing for the Fed. I think the surprise will be if for some reason it's smaller than expected, at least on a temporary basis, a lot of these positions could be unwound. I think if that happens, I'd be looking to buy more Asian currencies on that dip, because I think at the end of the day, the Fed policy is coming. Quantitative easing number 2 is coming. It's just a matter of timing.
Okay, so Rebecca, talk to me about being bearish on the dollar. You were one of the first ones really to say sell off and lose the dollar in your portfolio. How weak do you think the USD may get, and how devalued do you think it's going to reach towards?
Well, the U.S. won't come out and say it, but right now a weaker dollar is definitely in America's interest. It's helping exporters at the margin, it's helping growth, and it's helping to fight deflation. So while I don't believe the U.S. targets a weaker dollar, it's certainly happy that it's happening right now. I think the only reason the Treasury might change its tune is if for any reason dollar weakness happened at such a speed that it started to undermine other U.S. asset classes. And we have seen that before, dollar weakness actually causing people to sell U.S. stocks as well. The Treasury won't like that, because a lot of Americans have stocks in their 401ks. The voters in America don't want to see the dollar hurting stocks. But unless that happens, you certainly aren't going to hear a peep out of the U.S.
Okay, are we in the midst of a global currency war then, Rebecca? Because if the U.S. dollar likes their currency weak, so do other economies, such as some would say China, obviously to some. And then you have Japan stepping in and intervening in the markets as well, South Korea, Brazil, Switzerland. What is this? What kind of picture does this paint globally to you?
Not a very pretty one, because it's not clear how it ends. You know, right now, policymakers are working in their national interest. The U.S. wants to do what's good for our economy. Europe is unhappy about the euro because it's not helping their economy. China's doing what it thinks it's best for its economy. So until you get global policymakers coordinating, which doesn't seem likely given the IMF meeting last weekend, everything keeps pulling on each other. We continue to have these strains. I think in a worst case scenario, and I hope this isn't my base case next year, we get greater protectionism, and that starts to spill over to other assets. It's not going to be good for stocks or cyclical assets generally. That's the worst case scenario. And again, I hope something happens before we get there.
Okay, but Rebecca, in terms of language, are we in the midst of a global currency war then? Would you point to that? Would you use that terminology right now?
You know, it's a great term for headlines. I don't know if we'd call it a war yet, but you know, what we are is beggar thy neighbor all over the world. Everyone's doing what's good for them, and no one's worrying about their neighbor so far, not too much. A war seems like we're doing it to hurt each other, and I don't think that's the case at all. I don't think the U.S. dollar weakness is meant to punish another country, or in China's renminbi situation. So I wouldn't use the word war. It's more of benign neglect everywhere around the world.
Okay, Rebecca, I'm running out of time here, but talk to me about the semi-annual currency report that's due from the Treasury this week. You, including a lot of economists, are saying that Tim Geithner is going to delay this until after the elections. But how many times can he keep on delaying this report? And doesn't it make the Treasury look impotent in dealing with China and the yuan?
Well, you got to pick your battle. Right now, if the Treasury were to put out their report on schedule, it would become a political hot potato weeks ahead of our midterm election. And that's probably not useful for the White House right now. If they delay it, there might be some noise around that, too, but probably less than if they put it out on time. Because when push comes to shove, is Treasury going to find China guilty? China's made its currency more flexible this year. Maybe not by a lot, but it has taken steps. So I think that Geithner would have a hard time pushing back to the Chinese saying you're not doing enough.
Okay, Rebecca, great insights. Thank you for that. Rebecca Patterson of JPMorgan Private Bank.